Hey, everybody, we are going to talk about some of Berkshire's favorite businesses, and you can't buy them, but we're going to talk about some alternatives that you can. So, Tyler is joining me today. Before we dive in, please take a minute and check out the link you see on your screen, fool.com/Frankel. You get the top 10 stocks from the Motley Fool right now, and it's the best way to support this work we're doing on YouTube. Again, fool.com/Frankel. So, Berkshire is at its heart, excuse me, at its heart is an insurance business. Um, Berkshire started accumulating shares of Geico a long time ago, then ended up buying the whole business. They have a big reinsurance operation. They recently bought Allegheny Insurance. They recently bought a big stake in Chubb, the big insurer. So it's clear to say that it's over the history of Berkshire, insurance has been really the one constant. Even all the other kinds of businesses that everyone says Buffett likes, energy, banking, they've really kind of ebbed and flowed in and out of Berkshire's portfolio. Bank stocks were like half of the portfolio not that long ago, and then he decided to sell pretty much everything but Bank of America and a couple of other small holdings. So insurance has been the constant. Geico is a solid business, but I wouldn't even call it the best insurance business. I think you can do better if you want a big insurer. And the one that I really love is Progressive. They are the company that it sounds like Berkshire really wants to be. Berkshire's even called it out in meetings. When Tyler and I went to the Berkshire meeting, the head of insurance, Ajit Jain, said Progressive has really just done better than Geico at technology, and that Geico needs to catch up. Um, Progressive is kind of, you wouldn't think of it as a technology leader in insurance. There are tech focused insurance companies that have gotten more publicity, deserved or not. I think like Lemonade and things like that, companies that are building the next tech platform. But you might be surprised at how good Progressive has been at technology. Just Lemonade acquired a company called Metromile to do vehicle telematics and things like that, and help them price insurance and do better like that. Progressive has, they rolled out their first telematics device 20 years ago. This is not a new idea. Tracking how drivers do and using that to price their insurance and underwrite better and things like that. Progressive has really been a leader on that. And even since 2011, they rolled out kind of a wider scale platform called Progressive Snapshot. And that's really what the kind of you put a device in your car, it collects data, and then Progressive prices your auto insurance based on your habits, whether you're a safe driver or not. Some people might want that in their car. Some people probably wouldn't want that in their car. Um, but this is not a new idea, despite what some of these tech companies will tell you. Progressive has been using this and using it successfully for a long time now. It's been so successful that Progressive has not only been able to price compete with companies like Geico, but it's also been able to underwrite better and make more money. The price competition is allowed, and just service and just the oh no, their app is, what's the opposite of clunky? I can't think of the word right now, but their app is very easy to use. The claims process is very easy to navigate, and it has allowed Progressive to actually leapfrog over Geico for the number two auto insurance market share. State Farm is the number one, if you're curious. But Geico is now number three, and they were number two for the longest time. And they've done so profitably. Um, Progressive's free cash flow has grown by 670% in the past decade alone. And it's not just that their investments are doing well, which right now in the insurance industry is generally benefiting from higher interest rates in their investment portfolios. Most insurance companies, including Progressive, primarily store their money in fixed income instruments. Berkshire's a big exception to that. But Progressive generally owns boring fixed income instruments, and these are paying a lot more interest than they were just a few years ago. But it's not just that, they're underwriting very successfully too. For the past 20 years, the average property casualty insurer has run a combined ratio of just over 100%, 100.1% on average, meaning that the average insurer is breaking even on underwriting and making its money from investments. Progressive has been 96% or less, meaning they have an underwriting margin of 4% or more during that period. And in recent years, it's done even better. Recently, in August 2024, the most recent data that was reported, Progressive had an underwriting margin of over 11% before even taking investments into account. So that's why they don't really feel the need to take a big risk on any of their investments, because they're making so much money on underwriting, because of all their superior technology allows them to underwrite better than the competition while still remaining very price competitive. It's a very consistent moneymaker. They've done a great job with marketing. I'd actually say that Flo, the progressive lady, is more well known than the Geico Gecko at this point. I don't know that we can argue that, but I just think the management's done a fantastic job, and shareholders have already been kind of handsomely rewarded. Um, but I think this is a stock that could continue to beat the market for years to come. So that's kind of my preference is in terms of big insurance. Tyler, what's your Berkshire alternative you're thinking of?
Yeah. So if you go through the Berkshire portfolio of the operating companies, not the publicly traded ones, you'll find there's a lot of cyclical industries, especially in like the home business and the RV business and the manufactured home business. Specifically, one of the ones that really stands out as one of the larger ones is Clayton Homes, which is one of the largest manufactured home builders in the United States, which it's a decent business. It's cyclical. It's kind of hard to do well, but the companies that can do it well can do it very profitably. And so one of the companies I wanted to highlight here, because they're very much in that Clayton Homes sort of theme, is Champion Homes. They are also a manufactured home builder. Manufactured homes, it has a little bit of a stigma to it, because you hear the term manufactured home, and the automatic assumption is building homes for a trailer park, but that's not necessarily the case. They also build modulars. They also build kind of like their custom build modulars, where it'll be like 4 or 5 pieces brought onto a site at the same time. It's basically like trying to automate as much of the build and construction as possible at a factory or some sort of single job site, versus trying to do stick build or on-site construction. It's considerably cheaper than trying to do on-site construction, but it's something that it does have certain limitations, because well, it's kind of hard to transport a modular house. So at least from the economic, not just logistically but economically as well. But all that said, if you can get into certain areas and of like suburban, exurban, where it allows for a lot of development, these manufactured home facilities that can kind of crank out a whole house in 5 to 6 days, I think, is the typical turnover for these businesses. You can drive out a lot of efficiencies and do it for much cheaper. And that's largely been the case for Champion Homes. And just to give you an idea of like, you know, being really good at what it does, uh, even at the worst of the industry cycle for manufactured homes, which was 2008, 2009, and arguably this past couple of years has been pretty bad in terms of total home sales. Returns on invested capital for this business have stayed above 8%. And for a business that is debt free, 10% of its market cap is in cash, it doesn't pay a dividend, but it does have a tendency, it reinvests in the business relatively well. And there is a lot of opportunity, I think, in manufactured homes, because we have been talking for a really long time about affordability in the United States, and manufactured homes was huge in the 70s, 80s, and 90s. It kind of got a bad rap for poor build quality, but the build quality on new manufactured homes is considerably better. On top of that, Champion has brought in its own captive finance and insurance arms, because these types of homes typically have a harder time. People trying to build these to have a hard time getting financing for them, because it's not built on site, so you're buying land and then doing construction, which can be really expensive when you're doing it. So captive finance arm has been a good way to do it, and allows them to get. They're really good at getting what are called federal housing authority, not federal housing authority, urban development, and kind of like low cost housing Ginnie Mae loans, versus like the typical Freddie Mac, Fannie Mae loans. It's a little bit smaller market, but having that captive finance arm is going to kind of grease the skids a little bit more to allow this to happen. And toss in a couple other things like kind of liberalizing of zoning regulations that have traditionally prohibited the use of manufacturing homes, because Again, it's kind of a stigma thing, largely in the United States. So I think there's a lot of opportunities for manufacturing homes in general. And in that position, I think a company like Champion Homes, with its very good operations, its good returns on capital, and a very prudently managed balance sheet, I think it's one of a great example of a Berkshire Hathaway type company that individuals can own that Berkshire can't, because it's only a $5 billion company. And before I forget, the ticker on that one is SKY.
I want to thank The Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for investors of all skill sets and risk levels. You all know how much I love researching new stocks and trying to find the next best investment. So I'm proud to partner with The Motley Fool to bring you 10 stock picks from the popular product Stock Advisor. Stock Advisor has beaten the market by nearly 5 times. So go to fool.com/Frankel to get your 10 stock picks now. The Motley Fool Stock Advisor returns are 767% as of July 5th, 2024, and are measured against the S&P 500 returns of 163% as of July 5th, 2024.